Hello, thank you for tuning in once again, and appreciate your views and your likes. Please don't forget to like and subscribe, and always put God first in everything you do, and that will solve a lot of your problems. You can stay out of trouble. Now, I also want to say that I lost my wallet recently, so I'm probably going to step away from this series and go back to it, but I'm going to do a video on identity theft protection coming up soon. However, I will labor myself through this particular video here, and we're going to talk about tax-deferred investments here. And I'm going to kind of bounce around a little bit. And the reason why tax-deferred investments are important is because when that money comes out, you are taxed the ordinary income tax bracket. So I am going to relate this to a couple things. But before I go off, I'm going to isolate those areas of deferred investments. And let's go here. Let's start off with employer-sponsored plans. And some of those is, well, a lot of us are already familiar with them because we have regular jobs, and some of these is employer-sponsored venues, I should say, to facilitate that tax-free income comes in the form of a 401k plan, a 403b, or a 457 plan. The second area that you can do this tax defer, where if you look at the screen, you can see the tax deferred money going in, and then it's tax coming out, which would be a individual retirement account or a traditional IRA. So, which allows you to roll money at a tax deferred basis. However, you contribute these dollars after taxes. So you can see how it can get a little complicated with all the different minutiae when it comes to these particular areas. So, and last but not least is probably one of many individuals' least favorite topic, which would be an annuity. An annuity, although it falls in the form of an insurance product, you can also use these to set up your own type of private tax-deferred retirement account. But as I mentioned earlier, this money goes in tax-deferred or after-tax dollars, and then you are taxed at the ordinary income tax bracket. And I'm going to share with you the U.S. national debt clock. So if you can look over here in the corner, if you can see the tax revenue over here is in the 2 trillions. So you got the billions and the trillions. So what I'm going to do is I'm going to go backwards a little bit. So let's take a look at these numbers. We can't focus in on every number, but let's at least agree that we're in the trillions on payroll tax here. We're in the trillions on income tax revenue. And then the U.S. federal tax revenue is in the trillions as well. So let's go back to 1980. And let me blow this up for you a little bit, or enlarge. People don't like to say blow up. That means that you got some cut on it. So now, if you look at these numbers over here, these numbers are relatively somewhat manageable because they're in the trillions. So, excuse me, these numbers are in the billions. Please forgive me. So billions versus trillions. And you say, well, what's the difference between $1 billion and $1 trillion? And this is the reason why I'm showing you this one at a time here. And what I'm going to do is show you me a second. I'm going to show you what $1 trillion looks like. So this is $1 trillion. Take a look. So I'm going to speed it up for you a little bit. This is going to just show you the significance between $1 billion and $1 trillion. And the reason why this is all important because, I don't know, if you're breathing, that means that you pay taxes. There's taxes on everything. There's gas tax, income tax. There will be tax in your retirement. I'm not sure if there's tax on your burial. However, the people who arrange that are going to be taxed. So we live in a tax society. You think we live in a capitalistic society, but it's actually a tax society. So we're just going on along here. We got several buildings taller than the Statue of Liberty there, which represents stacks of money. And we're going to take a bird's eye view because we still have not quite eyeballed the trillion. There we go. So let's go back to a new share, and I want to show you the tax bracket on those investments. So let's go here. Here. And here. All right, so if you just take a look over, this is what you call a historical tax bracket. This is not made up, these are actual rates here. So this is the 1913s, you know, bad economies, world wars going on there, quite a few wars America's been involved in. And these are all paid by tax dollars. This is, you know, our strength is what we represent here, homeowners, consumers, incomes, jobs. This represents the tax rate bracket. So if you see the average maximum rate was around 59.6%. This is the average minimum rate. So this depends on your income. So if you're looking at 2022, you see here that the tax bracket is somewhere around 38, 37%. However, where do you think taxes are going to go? Taxes will most likely go up. And according to this author, David McKnight, which I read and follow, I would strongly take a look at what he says here. Let me see if I can hover over that. But take a look here where it says 34.9% will rise to 88% tax bracket. So based on where we're going right now, this is where we're going to end up. So the new lower tax bracket would be the 25%, and the median would be 63%. So let me go back over here to the new share. And we're going to go back to the tax triangle. I'm going to plug in a couple things over here to see what we got. So over here you have money coming in and money coming out. So you say, hey, I'm going to put this money in my retirement plan. I got it all worked out. I got my income set. And when you're retired and you're all sitting out on the lake and you want to go on vacation, you forgot all about the tax bracket. And the reason that's significant, I mean, it could have a huge impact on your income, and I'm going to show you why here in a second. Now, I'm sure a lot of us would love to have these type of problems. So this here is a before tax well, it's going to show a traditional IRA at the top and the Roth IRA over there. I'm not really focusing in on the Roth side over here. It's just serving as part of a comparison here. What I want to pay close attention to is this area over here, which is the before tax value, which we spoke about. So whether it's an IRA or a 401k, and I just want to be specific, whether it's an IRA or a 401k, which goes here, tax deferred, IRA, 401k, doesn't matter. We'll go back. That income that you lived off of or plan to live off of would have to be substantially adjusted. And you can probably do the math yourself. However, based on this $146,000, excuse me, $146,000 a year, an average person would say, well, hey, I have at least 10 figures I can live off of per month. Excuse me, 5 figures. That would, you know, that would be over 5,000 a month. So what I'm going to do right now is show you the calculator, because one thing about me, I don't like to talk about it. I like to be about it. And I'm going to take the $146,093 that we earned, and I'm going to divide it by 12. Now, I know we all have to pay our fair share, and I'm sure anyone will say, well, you know what, if I make $12,000, what would be a fair amount that would go to taxes? Someone would say, well, $2,000. However, based on your $146,000 income, you're in the 28% tax bracket. So at that 28% tax bracket, you will be minus 41,000. I'm going to show you that on the other screen here in a second. So that 146,933 minus the 28% tax on that of 41,141. Oh, that's wrong. So let's go back. Let's clear that. 46,933 minus 41,141. So that leaves you 105,000 divided by 1, 2. That's almost $4,000 a month that you need to shill out to the Uncle Sam. You know, that's not a bad deal, but I'm sure many of you didn't plan for that. Little caveat. So I am going to take you back to this screen so I can back up the numbers that I mentioned there. So we look here, 28% tax bracket, yada, yada, yada. So it's a scale. And the reason why this is so important is that when you earn money over here, your after tax value, well, this is a conversion. This is the reason why I don't want to focus on this. This is a conversion. This means that you converted something from here to there. So we will not focus on conversions at the moment. We will go back to the tax triangle. So the reason it is important for you to balance out these areas is in that you will come across taxes. And that will end my video for today. Thank you.